Good afternoon and welcome to Associated University, a group that is designed to provide supply chain management professionals with access to information on practical solutions concerning the industry's current hot topics. Today we will be discussing lift truck fleet replacement and acquisition strategies, including key metrics that will allow you to properly determine when your lift truck has reached the end of its economic life, as well as how to use those metrics to develop a fleet replacement strategy. Also, how to determine a financial acquisition strategy for the purchase of new capital equipment while preparing for the financial impacts such as taxes and deductions. For today's webinar, we will have two presenters. First is Scott Penger, who is the Fleet Optimization Manager at Associated. As a seasoned consultant, Scott has more than 25 years of technical and operations experience, helping clients effectively manage fleets of all sizes in a variety of industries. Secondly, we have Joe Vittori. Joe is the Director of Finance at Associated. Joe has an extensive financial background rooted in supply chain. He comes to us with over 12 years of experience in helping clients develop financial strategies that allow them to acquire the capital equipment they need. We have scheduled 15 minutes at the end of this presentation to answer any questions you may have. You may send your questions at any time during the presentation or at the end by simply typing your questions into the questions pane of the control panel. Following this webinar, we will also be providing all attendees with a copy of this presentation. And now I will pass it over to Scott to get us started.
Thank you, and good afternoon. Just to start this off, I'd like to start with a poll question. If you could click on the size of your fleet, what is the current size? We'd like to tally that up and kind of provide that back to you. Fleet size really doesn't matter in the content we're addressing today, as the topics we will address are applicable to any size fleet, whether it's 15, 150, or 1,500 trucks. The hope is for you to get a better understanding of some new or improved ways to analyze your fleet and provide relevant content over the next 45 minutes. Looks like roughly 38% have 100 plus trucks in their fleet, and about 25% are showing up at less than 15 trucks in their fleet. So we'll start off by looking at current trends in the replacement and retirement schedules. This graph was taken from a lift truck acquisition and usage study that was conducted in 2017 by Modern Materials Handling. What the key item to focus on here is the trucks in the red box that are covering ranges of 5 to 8 years and 8 to 10 years. There are still a significant portion of companies holding onto their equipment longer than the 10-year or older category. This is an item we will address today, and how the age and cost of these trucks in these ranges will affect your overall fleet costs as well as productivity. Another interesting item to note is the bars on the left showing a trend as it relates to possible lease trucks, things that are replaced in under 5 years. This is a scatter chart showing 4 quadrants as the economic point of return, addressing both utilization and cost of your fleet. And in the first category, this is really where no action is required. This is the sweet spot. This is where the trucks have high utilization with a low cost. These are trucks that are doing the most work within your facility and really are, again, that sweet spot. So we progress down. This is a quadrant that really is one that you need to reevaluate. Your low utilization shows you're really not utilizing these trucks. They're not getting a lot of cost tied to that utilization. And really you should evaluate whether you can supplement these with short-term rentals and really what the status of these is in your fleet. Next, we're going to look at removing trucks. These trucks are low utilization, but costs are tied to them. So these are really pieces of equipment where you're spending far too much money with little return and little usage. So you really want to look at possibly pulling these from fleets, and then if you have something that you can supplement from a short-term perspective with rentals, that could be a very good addition as well. Next, we'll look at the impact of rental equipment. Do you know what you're currently spending on your rental fleet? If you have high rentals, you may want to look at reducing these. And do you need to rent when your fleet may contain underutilized equipment? Is there equipment you could be bringing in to supplement that, therefore reducing your rentals? Or is this something you could get rid of and rent on a seasonal basis? So these rental spends can be reallocated to help with the replacement strategy. And what that means is that money that you're spending on rentals could really be applied towards replacement of older trucks or high-cost trucks in your fleet. Heading back to this scatter chart, the last quadrant we're going to talk about is the replacement. And these are trucks where you're getting high utilization and as well as high cost tied to them. So these are the trucks, obviously, that you really want to look at putting at the top as a priority to replace within your fleet. You're not going to supplement these with rentals. These are really highest cost factors within your fleet. So the 4 factors we're going to look at to consider are the type, model, age, hours, and cost per hour. The first one we're going to address is the type and model of equipment. And again, we have a chart taken from this same study by Modern Materials Handling in June of 2017. It really shows the 5 classes of trucks that we address most typically. And it shows really what people are using, what they're acquiring, and what they have in their facilities. The counterbalance trucks, sit down and stand up, are the strongest, both in 2016 and 2017, as well as your electric-powered pallet trucks, walkies, and riders. And then you have some other class 2, 3, 4, and 5, which are your IC-powered internal combustion gas trucks. So here are some outliers as it pertains to that. The class 3 pallet trucks, these are really low cost of ownership. They're a more affordable piece of equipment, and as a result, they get a lot of usage just based on their application. Due to this, repairs and parts can get costly over time, and you may go and spend a little bit more on these pieces of equipment a lot sooner than you should actually be looking at replacing them. An additional outlier is the class 2 swing reach. These pieces of equipment have very high cost of ownership to get to bring them in, and they're very expensive to maintain and repair. And as a result, they also have low usage. They spend a lot of time on wire in aisles, and as a result, they do not travel and build up those high hour meter readings as it pertains to travel and lift. And then the components can be age sensitive. So what that means is if you had a display or something of that nature on your truck and it was 6 to 7 years old and it failed, you would be looking at a repair, and it may need additional system component updates, software, things of that nature. So quickly, a simple repair can compound and become costly. And lastly, in those trucks, oftentimes a warehouse design is based around their use. So they are on wire. They have a narrow aisle where other trucks would not be able to operate in that environment. Lastly, as an outlier, is class 4 and 5, very similar trucks. One is cushion IC and the other is pneumatic. Those are both heavier duty pieces of equipment. The costs are higher in their maintenance just because they have more systems such as transmissions, fuel system, emissions, and cooling. And as a result, those components fail and those repairs will be greater over the life of the truck. In addition to that are just higher costs that go along with the environment they work. So this additionally can impact some of the costs as it relates to the age of the truck. Next, we will get into the age. And from, again, this same survey, we look at the average age versus the oldest age of lift trucks that people responded. And it's pretty interesting to see that there's a significant portion of people keeping their equipment at that 10-year or greater point. And even more so interesting that there's a significant amount of their fleet that is 20 years or older. So that's really something that kind of ties to what we're speaking to here and why you may not want to keep equipment that is that age. So when talking about the age of your equipment, how you figure out some of that is often complex for people who aren't in that field every day. Looking at the serial number and how you find that. One exact way is the specification tag that is located on or near the operator compartment. It's also known as a data tag. This would contain the serial number, maybe some specifications, capacity, load center, etc. And we have a couple examples. So the first here would be a Raymond lift truck. And as we have an example of a 750-13-AB31546, the underline 13 would indicate the year. And in the second example, the R50-07-21346, it's contained in the 07, being a 2007 truck. Yale's a little bit different as another example. They contain it with a letter indicator at the end of their serial number. So in the example we have there is a V. That V indicates the year of production. So they would start off as an example at the year 2000 with the letter A, and that would roughly be somewhere around the year 2020. I'm not saying these tie in directly as it pertains to that, but it's a good example of how they provide that information. Here's an example of how much trucks cost as they age. In a fleet of 100 trucks, we average out about 10% being the right number that people would often want to replace. And you can see the cost per hour being at $2.81 at a 10-year-old truck. And we find the average hours over the course of 1 year would be about that 1,240 to 1,560 range. So doing the math, you're spending about $35,000 per year on those 10 trucks. By replacing them at a lower cost per hour, you're looking at about 94 cents with the same annual usage. There's about a $23,000 savings. So you end up with almost the price of a truck in value and replacing that equipment. Next, we're going to address the hours. And the way we look at hours is predominantly by dead man. That is defined as the number of hours a truck is actively retrieving or storing loads. Additional ways are lift hours, which is fairly simple, up and down, putting away product. Travel hours is the actual movement of the truck throughout a facility, and key signifies how long the truck is turned on with the ignition. Some other ways that you can help to identify this, besides just the meter on the truck, are through the display if that's available. There are often selectors to choose one of these different options. Also looking at work orders or invoices from a service provider. That can give you a good range of where your truck is at. And lastly, but a more recent topic, is telematics, and that is an automated process of inputting that into computer software. Next, we're going to look at usage and utilization. There's a couple of ways we can collect it. Again, there's a monthly manual version where you just would kind of go out there and collect them physically on site with the truck, or creating a calculation where you have two documents containing the amount of time between the two repairs and calculating that. We do have a formula in which you take the hour meter readings divided by the days, multiply the average year, and then you come up with your annualized hours per year. One thing to note there is just the greater span of time between those two, you get a more accurate idea of what your actual usage is. Speaking of that, here are some averages. We show again the average of 1,240 to 1,560 over the course of a year. Three outliers again are the pallet truck, swing reach, and the gas, pneumatic, and cushion trucks. The reason those three are brought up again is pallet trucks often are overutilized based on just hours. Swing reaches, again, do not travel or operate very often just based on their environment in comparison to the average, and then the gas trucks as well. Underutilization is anything under the 500-hour range. Of course, overutilized would be trucks that are excessively higher than the 1,560 top end of the average. The last section, cost per hour, that we're going to talk about. What are the cost per hours of your lift truck? So if you take your average annual maintenance cost, you divide it by the utilization over 1 year, you get your cost per hour. So in this example, 4,500 divided by 1150, that's about $3.96 per hour. So when you're looking at this, some things that you do want to consider is a large repair. Large repairs such as a drive unit, transmission, or a mast, something that costs several $1,000s, right out of the gate, that is going to immediately cost a greater increase in the cost per hours. Underutilization, kind of changing that formula around a little bit, will drive those costs to immediately go up as well. An important thing to notate is the data integrity. You want to make sure you're collecting all of your information as accurately as possible. It's often some topics that are hot for people when it relates to service providers having accurate hour meter readings or maintenance costs in general. Also, industry average versus your environment. This is, kind of understanding, are you the average or are you not? Perhaps you have a cold storage facility and you know that your costs are higher based on that, and you want to kind of adjust your business model based on that. The fluctuations in business needs, these could be an increase in overall business or a seasonal approach. So just something to keep in mind when you are doing your cost per hour analysis. Additional factors to consider, time. We strongly believe in a rolling 12-month approach as opposed to a life to date over the entire age of the truck. This shows you your current business model, kind of allows you to see the here and the now as you're trending. An additional factor is downtime. We want to make sure that you're addressing this as part of your cost and don't underestimate your repairs for that. Age is the last section here, and factors to consider with the older equipment being predisposed to higher costs just naturally. So here's a chart tying back to what we've talked about. As you can see from one of the outliers we spoke, the top truck, the swing reach, it really starts off at about $1.75 per hour. It climbs over the 10-year period to about $4.50 per hour. The age of this truck is truly driving the costs up, and that is something that you want to make sure that you definitely take into consideration. Contracted maintenance and part repairs for the year in question are something you want to pay attention to, and also make sure that you calculate in your in-house maintenance team burden rates. These are things that people don't always consider, and they add additional costs to your fleet and your overall fleet costs. So bringing it full circle, there are four major factors. We have age, truck type, hours, the cost per hours, data integrity. This is something we really feel is important. Calculating in your downtime, making sure you're paying attention to your productivity costs, and then your loss of productivity overall throughout the course of these repairs, and then focusing on your 12-month trends. Are they increasing? Why? What is the root cause? Really looking at those four factors: age, truck type, hours, and cost per hours. And then work to creating a fleet strategy. This is something that you want to work either with a third-party vendor or internally within your business unit to make sure that you create a fleet strategy to address these and stick to it over the course of the year. Make sure you stick through it. At this point, I would like to hand things over to Joe Vittori. Thank you.
Thanks, Scott, for that overview on identifying key factors for lift truck replacements. Good afternoon, everyone. For this part of the Associated University presentation, I'll be reviewing the different acquisition strategies for equipment. Once a company has established a fleet replacement strategy, the next step is aligning their acquisition strategy around that philosophy. There are various acquisition strategies to consider when making an investment in capital equipment. Those options that I'll be providing a high-level overview are short-term rent, purchase, and financial lease, classified as either capital or operating. Each of these will be discussed in more detail, but let's first start with a poll question. Today's poll question on acquisition strategies is, what is your current acquisition strategy for lift truck equipment? Rent, purchase, capital lease, operating lease, or not sure? Please take a moment to select your answer. Depending on the makeup of our audience, I expect based on the company size, these results will vary. So interesting, I'm seeing that 78% of our attendees are purchasing. That's 78%. Operating lease being at 11% and 6% not sure. But purchase and capital lease collectively together is 90% of the overall responses. And as I mentioned, depending on the company size, these results will vary. We're going to first go through short-term rental. This option gives a company the ability to source equipment as business needs demand with no commitment period required to the owner. Due to the flexibility this option offers to the renter, the monthly cost to rent is typically higher than other options and subject to price increases. This sourcing option is not typically used in acquiring equipment for companies' fixed fleet of equipment. Instead, this method is often used to accommodate seasonal needs and equipment breakdowns. An important note to mention is that making the decision to rent doesn't rule out purchasing equipment. Many companies consider renting as a path to ownership. This option is an excellent way to test out equipment before committing to an investment in capital equipment. An outright purchase is typical in a company where a lift truck replacement strategy has not been established and lift truck equipment is acquired as a need comes up. We see this in warehouse applications where customers are extending the equipment life expectancy beyond normal conditions due to lower utilization. When purchasing equipment outright, there is no obligation to a contract and no interest payments are made to a financial institution. The company will establish the purchase in the accounting records as an asset with depreciation expense amortized over a period of time. That period of time is determined by the company's expected life cycle of the equipment, which takes into consideration the type of truck, the age, the application, the number of hours it operates per year, and the frequency of maintenance. These are similar to the 4 factors Scott discussed on identifying equipment replacements. These are all important factors to consider when assessing the life expectancy of equipment to ensure the cost is matched appropriately against the benefit of use over a period of time. The IRS does currently allow for accelerated tax deduction called bonus depreciation on the income tax return. This allows companies to take an immediate first-year tax deduction of 50% on the purchase price of the equipment. Bonus depreciation has been a trend in the U.S. tax law to allow businesses to recover the cost of capital investments more quickly to incentivize economic growth. As economic conditions improve, the Stimulus Act of bonus depreciation phases out. Bonus depreciation is eligible through 2019, with the provision percentage phasing down to 40% in 2018 and 30% in 2019. A capital lease is similar to an outright purchase, with the exception the company doesn't use cash for the upfront acquisition cost of the asset. It effectively captures the ownership of the equipment, but employs 100% financing. The lease is typically structured as a 36, 48, or 60-month lease, depending on the company's expected life of the equipment. The shorter the term, the higher the monthly payment will be. Similar to a purchase, the company will establish an asset on the balance sheet, along with a liability to reflect the amount owed to the financing company. And the same tax benefits are available on a capital lease as with an outright purchase. But when it comes to leasing, many companies avoid capital leases because of their balance sheet impact. But despite the impact on the balance sheet, this option conserves cash upfront and is the primary benefit of a capital lease to an outright purchase. The other leasing option available, operating lease, allows a company to construct a lease to avoid the balance sheet transaction, often at times referring to this as off-balance sheet financing. An operating lease is a contract where the owner, called the lessor, permits the user, the lessee, the use of an asset for a particular period which is shorter than the economic life of the asset, without any transfer of ownership rights. Similar to a capital lease, the lease terms are typically 36, 48, or 60 months, with payment amounts increasing with the shorter the term. Payments made on an operating lease are treated as an operating expense for the company that is 100% tax deductible. Because there is no ownership rights transferred, the equipment does not qualify for bonus depreciation on the tax return. So what are the advantages of an operating lease? First, no cash outlay. It's 100% finance as a source of acquiring equipment for smaller, growing companies. Avoids capital budget restrictions. Often because these transactions are treated as an operating expense, they do not require the need to be approved by the finance department, as the equipment is not being allocated to a capital budget. It diversifies funding sources outside of cash and credit lines that are needed to cover the day-to-day overhead of running the business. This allows certain financial measurements to not be affected that could impact the company's ability to borrow cash. Pay for the equipment while it produces allows companies to match the outflows of cash for the equipment against the inflows generated by its use. Fixed lease payments allow more predictability in operating costs for warehouse operations. And finally, it facilitates scheduled replacement. The operating lease strategy is where we see companies utilizing to accomplish their lift truck replacement strategies. This allows a company to manage a replacement strategy that allows them to replace assets at the most optimal point in the time of the life cycle of an asset to ensure the lowest cost of ownership. This supports the topics that Scott discussed that addresses the increasing operating costs of a lift truck as the equipment ages. This next slide has a table that illustrates the advantages of leasing against those other options I previously discussed. First, no upfront cash is accomplished in all options with the exception of purchasing, which requires a company to use cash or credit lines to make the investment. Avoids capital budget restrictions. As I previously mentioned, the operating lease as well as short-term rent allows the acquisition of equipment without the need for financial approval, whereas purchasing and capital lease require the asset to be established on the balance sheet, which will require in most cases approval from the finance department. Diversifies funding sources. Both operating and capital lease utilize financial instruments in the acquisition of equipment, where purchasing and short-term rent use cash or credit lines of the company. Pay for equipment while it produces is accomplished across all options, with the exception of purchasing again. Purchasing requires cash to be paid upfront on the equipment, with the benefit of the use of equipment earned over a period of time. This is simple cash flow matching principle. Fixed payments, predictable costs is consistent across all options. Facilitates scheduled replacement is an important highlight on this table that only has a benefit on the operating lease option. As I previously mentioned, this is where we are seeing companies align their strategies for acquisition when implementing an asset replacement program. Maybe the path of least resistance supports avoids capital budget restrictions. If finance approval is not needed, the acquisition of equipment through operating lease or short-term rent can yield a shorter period of time on getting equipment that is needed within the operations of the business, requiring less approvals. Uses equipment is the alternative to owns the equipment, which requires the transactions to be recorded on the balance sheet. Both operating leases and short-term rent are treated as operating expenses and not required to be recorded on the balance sheet. Off-balance sheet was just mentioned and is the option that many companies are looking to utilize to protect certain financial measurements. So as you can see on this table, any cell with a yes is highlighted in yellow or dark orange to highlight the benefit. Cells with a dark orange are a benefit today, but will change in 2019 with new leasing standards that are required to be adopted by all U.S. companies. All U.S. companies are required to follow GAAP, which is generally accepted accounting principles. The purpose of GAAP is to ensure that financial reporting is transparent and consistent from one organization to another. The new leasing standard presents dramatic changes to the balance sheet of lessees. The change is aimed at increasing the relevance and faithful representation of financial reporting for lease transactions. Under the old GAAP rules, operating leases were not required to be recorded on the balance sheet, instead disclosed in the financial statement footnotes. This change will now require both capital and operating leases to create an asset called right of use and a corresponding liability on the balance sheet. Any lease with a term greater than 12 months will be impacted by this change, which will include most all operating lease contracts. The change is effective as of December 15th, 2018, with early adoption allowed. Now, non-public companies will have an extra year to adopt this change. So where will your business feel the impact? As mentioned previously, losing the benefit of off-balance sheet financing could impact financial ratios and debt covenant compliance. Pre-existing leases will not be grandfathered, so outstanding leases will be required to be stated on the balance sheet. This could result in the need for new processes, systems, and controls to track lease contracts. That is one of the biggest issues in all organizations today, is getting visibility to new lease contracts signed by individuals of the organization. Also, the new asset on the books could affect certain federal, state, and local tax calculations. This could make a change to companies' acquisition strategies. For the accounting and finance folks on this call, these tables illustrate the before and after effect of the balance sheet and income statement. As you can see, there is no change to short-term rent or purchasing, but a major impact to the classification of an operating lease. Companies should prepare for this change now. There is a lot of content available on the internet through the Big Four accounting firms, as well as seminars, and I highly recommend companies take advantage of this to better understand all of the changes. What I just went through is just a high-level overview of these changes. There are a lot more detailed aspects of these changes that all accounting and finance individuals of corporations are going to need to be aware of, and also are going to need to make their operational groups aware of as how this changes the impacts to the business. This concludes my overview on acquisition strategies for equipment. I'd like to thank all attendees for taking the time out of your day to attend this session.
Well, thank you, Scott and Joe, for presenting this material. I would also like to thank everyone who joined us today. We hope you found this information to be relevant and valuable to your organization. Following this webinar, we will be sending everybody a copy of today's presentation, as well as a very short survey about today's webinar. We ask you take a few minutes to let us know what you thought and offer any feedbacks on topics you would like to see included in future Associated University webinars. Additionally, if you have any questions about fleet replacement and acquisition strategies, please feel free to email us at info, that's I-N-F-O, at associated-solutions.com. Thank you and have a great day.